Hey CFMA, my name is Joe Harper and I'm the corporate controller at Kelly Brothers Roofing in Fairfield, Ohio. And the answer is absolutely. Corporate budgeting is covered in chapter 13 of CFMA's The Book. And we're going to quickly highlight some of the major points of that. And if you're not familiar with that resource, I really encourage you to check out the CFMA's website at www.cfma.org. So the first thing to recognize in your corporate budgeting process is the difference between strategic planning and annual planning. Strategic planning is looking at what your organization could do and is it doing the right thing and kind of looking at what you can do with your resources. Annual planning takes the results of that and distills it with the history and some other things to come up with the annual operating budget. Now, the annual operating budget is really the baseline for your control for the next year. It demonstrates management's understanding of their business, and it gives some near-term performance measures for the organization. And it's really a decision-making tool, because if you're ahead on the corporate budget and you feel good, probably going to make some different decisions if you're behind in the corporate budget and kind of anxious. So again, it's a decision-making tool. So we're going to jump into the operating budget. That's what we're going to talk about in this video. So what is first? The first part of the annual budget is to identify the inputs. What information are you going to need to produce the annual operating budget? So the major components of the operating budget are projected construction revenues, direct construction cost, indirect cost, overhead, and then very important is the owner's ROI. What's the goal for ROI for the year? Now, in my experience, revenue drives the effort. So getting the revenue right is really the first part of that and the most important part of that. So after the inputs are gathered, additional considerations we have the data. So we have when you're looking at the construction revenues, you're going to look at a lot of different things. You're going to look at what you have in the hopper. You're going to look at what you've done in the past, your strategic plan. What are we going to do in the future? But then you have to apply the internal and external limiters to that data. And internal limitations are things such as labor force. Is there a supply of labor, not a supply of labor? Bonding capacity. What's our bonding capacity and how much bonded work do we do? What % of bonded work do we do? And then what are our capabilities? Are we capable of going outside of our comfort zone and getting into a new market? External limitations are really the market. What's the market doing? What are interest rates doing with the money supply? Labor again, and then what's our competition doing? And again, always keep in consideration the ROI objectives of the owner. I was always taught in budgeting to work backwards. You start with your profit first. Profit's your first line item, then you work backwards. And it really makes you think about budgeting in a different way. So finally, we're going to mention the outputs. So after we're done, what are the outputs? And the outputs are the annual operating budget. So that means a projected monthly, quarterly, or maybe just an annual number. That's the income statement and hopefully the balance sheet. With that, really you should prepare a cash flow projection with that. That's super important today. Lenders don't make decisions without cash flow. So if a lender is going to look at your business, the first thing they're going to ask for is the cash flow projections. Part of it should be the capital expenditure budget. What are we going to spend? When are we going to spend it to make sure that those large expenditures are planned out? If you have a debt balance, then maybe you want to do a projection of your debt service. And if you projected your balance sheet, you can do your KPIs. You can project your KPIs. Again, monthly cash flows for your construction projects, those are always good because your construction drives your business. And on your larger jobs, you should consider having specific projections for cash flow for those jobs. And again, detailed responsibility expenses by responsibility center. So if your company has divisions, you're going to need to take your data and separate it into divisional information so that your division managers have their goals. Again, this was a condensed version of talking about budgets and your annual operating budgets. I'd really strongly encourage you to check out chapter 13 of the book, and best of luck. Thank you.